Some people find trading stressful, but not me. Hi, I'm Shafiq. I'm a vlogger and trader, and today I'm sharing my best kept trading secret with you. I trade in local and global markets while on the move or even when I'm sleeping. I was one of those who were clueless about trading, but today it's all at my fingertips, 24/7, and I mean literally. Here, I trade in equities and futures at ease, and most importantly, at real-time prices. Everything you see here is live. And there's also Live Alert allows me to take action when the price is right for me on the Bursa-listed stocks. When it comes to a trading platform, you really want one that is convenient and what works best for you, preferably one that offers better trading opportunities. When you see a good trading potential but you lack funds to trade, no problem. You have access to additional financing. The secret to being a good trader is not a secret at all. Once you have found the right trading platform, equip yourself to make informed decisions. Only the right trading partner will make sure of this. I truly appreciate the daily current updates by trading research analysts on the RHB Morning Cuppa at 8. It keeps me informed and up to date. With RHB Investment Bank, it doesn't matter what trading experience or strategy you have, your individual needs will be met. They are committed to you. And because of that, they are available for you anytime, anywhere, even when Malaysia is asleep and trading is active on the other side of the world. This multiple award-winning service is the right fit for any trader. It's even more rewarding when you can collect loyalty points for great rewards every time you trade. Nothing is more worthwhile than this. What are you waiting for? Download the app and start trading.
Very good afternoon, everybody. My name is Alan. I'm from Group Retail Equities and Futures. Thank you for joining us for this special edition of update by our Chief Economist and also Head of Market Research, Dr. Sailesh K. The title for today's webinar is Fed Pauses, Hawkish Path Ahead, Navigating Rate Outcomes and Strategic Outlook. For today's session, we have the privilege of having Berlian Naryanto from RHB Sekuritas Indonesia and also Thanapat from RHB Securities Thailand to join me as a co-host. Thank you for dropping in, guys. So we are streaming this webinar live to our clients and also counterparts at RHB Thailand, Indonesia, Vietnam, and also Cambodia. So a big welcome to all of you. Thank you for joining us today. Recordings of this webinar will also be made available on Facebook closed group, RHB Morning Cuppa at 8. So you can also put in your questions at the end of the session. You can type in your Q&As into the Q&A box below, or comment box in Facebook, which I will address to Dr. Sailesh accordingly at the end of the session. So if some of these questions are not answered during this live broadcast, you can always drop it to your respective dealer so that the person in charge can further answer to your queries. Right, before we hear from Dr. Sailesh, please allow me to share some of these specials exclusively for you. RHB Small Cap Top 20 Jewels 2023 edition. So please join us for this webinar featuring RHB Top Small Cap Jewels companies for 2023 on 1st of July. 2023 from 10 a.m. to 12 p.m. So you can discover some of these hidden values and growth potential of some of these companies, which has been shortlisted and selected accordingly. So please register now to gain an edge in small cap investing. So in conjunction with the launching of the small cap book, you can triple your smart points with every online trade of top Malaysian small cap companies featured in RHB Small Cap Top 20 Jewels 2023 edition. So this campaign, the period starts from 16 May and it will run until 31st of August 2023. All right. For this year's Asia Money Retail Brokers Poll, we have our head of RHB Retail Research, Mr. Joseph Chai, in the running for the award. So please scan the QR code to vote for RHB as the top broker and also Mr. Joseph Chai as your favorite analyst. Okay, next up is our latest campaign from RHB Investment Bank. It's called Electrify Your Trades Campaign 2023. This has been running from 1st of February and will go on until 31st of December 2023. You will get a chance to win 236 amazing prizes worth up to 250,000, including the brand new Mini Cooper SE electric vehicle and 235 other vouchers. So the more you trade, the higher your chances to win more prizes. So next up is our share margin financing campaign. This campaign will run until 31st of July 2023. So for this campaign, when you open a share margin financing classic or exclusive account, you will get a special rate of 4.75% per annum, facility fee waiver, and facility limit can go up to 5 million with terms and conditions applies. Our next promotion is for Islamic share margin financing. A special rate of 4.05% will be offered. Waiver of CDS fee, transfer fees up to 20 counters and stamp duty cashback. This campaign will run until 31st of July. Now I pass to Indonesia for your campaign and updates.
Thank you, Alan. Hi everyone, good afternoon. Please allow me to share some of our local promotion in Indonesian client or Indonesia client in bahasa Indonesia. Okay, thank you. First of all, smart people, teman-teman semua, kita memiliki smart campaign di tahun 2023 ini dan masih berlangsung sampai dengan sekarang, yaitu smart fee, di mana transaksi di RHB Sekuritas bisa mendapatkan fee serendah-rendahnya 0,08%. Dan kemudian kita juga memiliki promo untuk margin rate sebesar 0,025% per hari alias setara dengan 9% per tahun. Dan berikutnya, setiap kali menggunakan aplikasi RHB Smart ID untuk melakukan transaksi, smart people akan mendapatkan poin yang bisa ditukar dengan e-wallet Anda. Dan yang terakhir, kita sudah mengupdate feature dari RHB Aro kita dengan Smart Analyzer, di mana sudah ada dukungan untuk mencari saham-saham dengan valuasi yang sangat murah dan menarik. Tentu saja sebagai investor itu diperlukan. Dan yang terakhir, kita baru saja meluncurkan pembukaan rekening untuk syariah yang mana sangat digital. Di sini adalah seamless, bisa menggunakan online langsung dengan memilih RDN Permata Bank Syariah. Selanjutnya ada satu video dari Ikuti kita.
I won't make it easy for you now. You got 2 minutes of my time. I don't really break too easily, but I'm worth it, 'cause I'll slip into your dreams tonight. Oh, so give me your all. I'll take it to Mars. Oh, I'll stick like glue inside your mind. Just watch me breaking. You'll swear you're falling into me, touch me. I swear you would do anything that I want, so keep us awake till the dawn. Baby, feel free. I wanna make you sweat on me.
Ya, dan RHB Sekuritas merupakan pelopor untuk warren struktur di Indonesia. Ingat warren struktur, ingat RHB Indonesia. Thank you, Alan. Passing back to you.
Thank you, William. Over to Thailand. Thanapat.
Hi, good afternoon, everyone. So, my name is Thanapat, moderator from Thailand. Let me share some promotion from Thailand in local. สวัสดีครับโปรโมชั่นสำหรับประเทศไทยนะครับเทรดฟรี RHB จัดให้ฟรีค่าธรรมเนียมซื้อขายหลักทรัพย์15วันทำการนะครับสำหรับลูกค้าใหม่ที่เปิดบัญชีซื้อขายหลักทรัพย์กับบริษัทหลักทรัพย์ RHB ตั้งแต่วันที่3เมษายนถึงวันที่31มิถุนายน2566โปรโมชั่นถัดไป next one please เทรดได้ให้เลย Diamond Plus ค่าธรรมเนียมซื้อขายทุก40บาทนะครับรับ3 point ทุกประเภทบัญชีpoint สะสมประจำปี2566เริ่มตั้งแต่1มีนาถึง31ตุลาค่าธรรมเนียมทุก40บาทรับ3 point ลูกค้าสามารถแลกซื้อกองทุนลดหย่อนภาษีหรือสินค้าสัมมนาคุณตามรายการที่บริษัทกำหนดนะครับลูกค้าสามารถตรวจสอบ point สะสม point คงเหลือได้ทุกวันที่2ของเดือนถัดไปผ่านทางเว็บไซต์หรือเจ้าหน้าที่การตลาดที่ดูแลท่านอยู่หรืออีเมลมาที่ thsupport@rhbgroup.com next one pleaseโปรโมชั่นถัดไป DCA Smart Fund ลงทุนต่อเนื่องผ่านกองทุนรวมกับบริษัทหลักทรัพย์ RHB ลงทุนต่อเนื่องกัน6เดือนและมูลค่าสะสม 12,000 บาทขึ้นไปรับหน่วยกองทุน K Cash เพิ่ม 0.2% ของเงินลงทุนอัตโนมัติหรือแลกรับบัตรกำนันของ Tesco Lotus ตั้งแต่วันที่11มีนาคมถึง31ธันวาคม Thank you. That's our promotion from Thailand. Thank you everyone.
Thank you, Thanapat. Okay, so without further ado, please help me to welcome Dr. Sailesh. Over to you, Doctor. Thank you for dropping by. Yeah,
good afternoon, Alan. Thank you, everybody, for attending our call, as usual. So let me just share the screen, which is the most difficult part for me, as Alan knows, and see if it works. Okay, share. Okay, Alan, is it looking okay, or you want to? Is it okay, Alan?
Okay, it looks good, Doctor. Go ahead.
Okay, good. And it's scrolling, right?
Yep.
Okay, so let's go to the main, basically the main chart, and so we can start there. All right. So what we can see. So let me start again. Sorry, I didn't collect my thoughts enough. So we came into the year on December 15, 2022. We released our global outlook in terms of markets and economies. And in April, we also had in the first week of April, our second quarter market and economic outlook. The resounding message since December 15 on a global basis has been to overweight equities, market weight fixed income, and underweight cash. We've been fairly bullish on U.S. stock markets, thinking that the U.S. stock markets will outperform across the world. After having been in a bear market last year, and that basically the euphoria that surrounded the China stock market would end. We had also thought that within Southeast Asia, that our favorite stock market would remain unchanged per my esteemed colleagues in equity research, and I definitely share that view. Not that I have an alternative not to share that view, is to basically be positive on the Indonesian equity market. So I was just in Indonesia last week for a couple of days, meeting clients, and the key message from my side, as far as the positioning goes in terms of how local clients in Indonesia are positioned, is overweight bonds, market weight equities, and underweight cash. That's just kind of like from a balance of risk perspective, what I'm seeing from clients, right? There's no formal survey, as all you know, right? Different from what we see in other developed markets and some markets here in Asia. So the sense that I have, since we won't be speaking for now a couple of weeks because Alan doesn't want me coming on too often and boring you, is that from a balance of risk perspective, I think that the portfolio allocation as far as Indonesia goes is to be overweight equities, market weight fixed income, and underweight cash. A lot of the juice and fixed income has already happened. For my esteemed colleague, the Thanapat in Thailand, from a currency perspective, so today we have something for everybody, all right? Usually I just talk about the US, but then it's good to also guide to you in the rest of the region what's going on. For Thanapat and colleagues and his clients out in Thailand, we essentially are long IDR versus Thai baht, simply because there's some political risk premium that is being built into the market, and for the short term, IDR Thai baht will go up from a currency perspective. So let's go back to the main event, which the concern of the market now is the Fed. All right. So in terms of our Fed, we just published it literally about half an hour or so ago. And you will see that we have changed our Fed forecast to 5.5 to 5.75% peak range from 5.25 to 5.5%. Our long-held view all the way back, I think, since December, January of this year. Yeah. And the Bloomberg consensus estimate is 5.3%. And from a financial market perspective, it is pricing in 5.3%. Nevertheless, we remain bullish on U.S. stock markets and continue to believe that the outperformance in U.S. equities will continue. And I'll get to that in a bit. So the key message is that even though we've changed our Fed view to much higher than what the market is expecting, this is one of the key themes playing out since basically last 2 weeks, where the Fed is headed. We're not worried. We continue to like, for example, the S&P 500 financial index, basically the banks index. We've done pretty well on that, where we've been long for several weeks. Our near-term target of 545 has materialized, and we remain in the trade at 580, right? So this gives you an idea or kind of a lesson, not to be your professor, but basically when market is very negative on something, it's always a good idea to retrospect and think what's being priced in, and what was being priced in and being priced in a little bit still in U.S. banking sector stocks is essentially crisis. And we've mentioned all along, there's no U.S. banking sector crisis coming. There's no credit crunch that will derail the recovery process, strong recovery process or strong resiliency of the U.S. economy and markets. So that's playing out nicely. We are now putting a new target, explicit target. So putting the foot to the metal is, we're long the S&P 500 index on dips with our near-term target of essentially 4,800. That's one of the highest in terms of index targets that people are looking at in the market. And China, the view has panned out very nicely. We've been selling MSCI China index since late January, early February. Returns have come down by like 7%. They're now around 1%. Continue to do that. And basically, the financials is an area we don't like as well. So sell the CSI financial index on any rallies, and the target is around 5,100. In terms of fixed income, because we revised our Fed view up, as you will see, the 10-year bond yield forecast for the United States, which plays into many asset prices in this part of the world, we're going to 3.7 to 4.2% from our previous estimate of 3 to 3.5%. We're selling 10-year bonds in the U.S. on rallies. We're selling Indonesia 10-year bonds on rallies because they've yielded in local currency terms around 9%, and the credit in Indonesia has yielded about 7 to 8%. So we think there's very little juice from our perspective in the long duration bonds in Indonesia. So we'd like to sell it, and that moves then from a balance of risk perspective. So watch for our detailed report coming out in the next couple of days. But all I can share with you from a balance of risk perspective, the portfolios locally will be shifting relatively more towards equities and less so to bonds in the next several months. So always useful to retrospect what has happened this year, right? We talked a couple of weeks ago, right? I think around a month ago. And I mentioned to you that the picture on total returns wouldn't change much. So what has happened? All right. The NASDAQ has given you 31%, and then the S&P 500 has given you good returns as well at around 15%. and what is basically the MSCI, bonds given you. You see U.S. high yield bonds giving you a paltry 5%, MGS 10-year around 4%, and the list goes on. And what you can see is the big China bulls, they're now basically gone back to their cage. When you ask somebody, hey, you were bullish on China and EM, they're quiet now. Okay? So MSCI China this year has given you only around 1%. So the way it has worked this year, what I can share with you is how has the market been positioned for the better part of this year? And this is very important for our view on U.S. stock market, is if you look at this bullet point, second to the last bullet point, item number 3, many global real money, meaning long-term investors and short-term investors as well, like hedge funds, have been overweight fixed income, market rate cash, and underweight equities. So to put it simply, they simply missed the boat. Okay, now the problem becomes they get a call from their boss, hey, what happened to you? Right? You completely underperformed. Yeah. And so what that means is that investors will be at the global level catching up, to meet the benchmark index, whatever they track for the particular asset class, for the particular portfolio that they are managing. So one of the worst trades this year has been wherein the bond portfolio managers have been going around in this part of the world, you name it. I'm not going to take any names, but all the big names that you can think about coming around Asia, trying to sell you a bond fund. Hey, listen, we can give you 6%. I'm like, who cares, right? 6% versus what you could have gotten if you had invested in the U.S. stock market at double digit in this chart, right? And it's not really, and it's not really 6% you'll be getting on a bond fund because the volatility is high. So if you adjust for volatility, in plain English, the returns from a volatility adjusted perspective is 3%. Equity volatility has been very low, right? Like, for example, the VIX, take one example, right, is around 14%, right? Low double digits. So you're kind of getting what you're seeing here in terms of the returns in the U.S. stock market. So the message I'm giving you is that the consensus has been completely wrong. And so what that means is that the consensus, the average investor will be essentially scrambling, as you see in the third bullet point, second to the last sentence, to put on positions to make up the returns which they've completely missed the boat on, to basically be overweight equities, and particularly in the United States, which seems to be the safe trade, the momentum trade that is materializing. Okay, and the other aspect of why we like U.S. equities, a view that we've held on like since fourth quarter of last year, is that the U.S. equity markets, have already priced in a peak federal funds rate of 5 to 6% in the fourth quarter of last year. And that's why we were in a bear market in U.S. equities, most of it, except the Dow, which was high single digit negative return, right? But the S&P 500, kind of like bear market, right? Already priced. So, when people say, oh, the Fed's going to hike more, it's not priced. I said, what are you talking about? It was already plugged into the discounted cash flow models of most top-down equity strategists in the U.S. already, and buy-side guys, that would basically mean that even if the Fed goes to our view at 5.5 to 5.75%, with the balance of risk, as I suggest, that the Fed could go higher to 5.75 to 6%, it's not going to matter much. That's why the equity market's rallying, despite the dot plot of the Fed last Thursday indicating that the peak Fed funds rate is now going to be 5.6%, not 5.1%. And that will not, from our perspective, are all buying opportunities in U.S. equities. The second bullet point of our bullish view on U.S. stock market is that earnings haven't collapsed. The bears have been suggesting all the way since basically early part of the year, the earnings are going to collapse, earnings are going to collapse. It's just like the recession's coming. It's like the boy who cried wolf. It's exactly like that. None of that has happened. And we think that essentially, given that the U.S. stock markets are a good representation of U.S. economy, you tell me your number for U.S. GDP growth, I'll tell you what the index levels are, okay? And in terms of EPS in the future. So we're at 2% GDP growth, and the market is essentially for 2023, Bloomberg consensus 1.2%. Take a wild guess, Thanapat, I'll put you on the spot. Take a wild guess in December 2022, what the consensus forecast for US GDP in December. Thanapat, take a wild guess. Today's 1.2%. In December of 2022, what do you think was the estimate by Bloomberg consensus for US GDP growth?
Less than 1%.
Exactly. You're absolutely right. See, so basically, the Bloomberg consensus estimate on December 15 would be plus 0.4%. 0.4% versus today 1.2%. 3 times, 300% increase in US GDP growth forecast. So can you rely on sell side and buy side views on US growth? Answer is absolutely not. You want to lose money? You basically listen to those guys, right? If you want to make money, listen to the RHB view. We've been absolutely spot on. So what that means is that from what we can see from the official data and our own proprietary indices or data for the US satellite images of the US economy, I'm going to reiterate I'm being very boring here, that as of the first week of June, we see absolutely no signs of recession, right? So it's like the boy cried wolf. Oh, recession is coming. Oh, it's coming in fourth quarter 2022. Oh, it's coming in first half of 2023. Now the view is coming in second half of 2023. And when we meet next time, we will probably be the market will be saying, oh, it's coming 2024. You know why? Because both the buy side and sell side have been completely caught on the wrong foot and are looking to enter the market. They want a market sell down to enter the market. That's how the financial markets behave. Nothing wrong with it. It's fine. I want the market to come down. Maybe I can buy more. Fine. But that's kind of not that's not the place you want to be in their mindset to play that catch up. So you want to be with the RHB view where we've been in the program all along. The third aspect, I already told you, is that most investors have missed the boat in terms of being overweight equities. Then basically the positioning is favorable. You always want the positioning to be light coming into your view. You know what I mean? If the position is already heavy, it means there's not much juice left. You know that for people to buy or sell either way. So let me go a little bit local because I've talked about the US a lot. So getting to basically the Indonesia view, right? So let me talk about it, fixed income. And then as you know, in Indonesia, the fixed income part translates into some momentum in the equity market. The resounding view among clients in Indonesia has been threefold of the concern related to from a balance of risk perspective. From a balance of risk perspective, let me reiterate, for the average Indonesian client on the buy side, it has been the case from a balance of risk that, commodity prices are, not going up. So if commodity prices are coming down, then we can't buy equities. And that's basically what they think is a sentiment among international investors where they haven't partaken substantially in Indonesian equity market recently. The second aspect of the nervousness has been the currency volatility. That currency volatility in Indonesia has historically been high, right? And that's like pre-2010 when we were trading an equity currency vol, dollar idea vol of basically 15%, 16%. We're trading 6% equity vol. The third is the political risk premium. We have elections coming next year. What I would say to all three is that listen here, long duration, the fixed income as an asset classes, broadly speaking, local currency government bonds in Indonesia have already yielded to you about 9%. The credit bonds, corporate bonds have yielded you 7 to 8%. And from what I understand from our colleagues in Indonesia, the JCI, Jakarta Composite Index, which barely always reminds me that's what the local investors look at. So yeah, they're yielding 1%. So if you believe in three things, in the RHB first, that the commodity prices like oil, food, and others from a balance of risk perspective, metals prices goes up in the second half of the year because we're bullish on global growth, where we think the recovery in the world, including the US, starts in the summertime, commodity prices are going to go up. So that if that's your main concern, then wow, take that off your list. Currency volatility, nothing to write home about. We think dollar IDR trades down to conservatively 14,000 to 14,500. That's our base case estimate. Our view for the quarter has worked out quite nicely, 14,500 to 15,000. Okay, currency, not a worry. In terms of political risk premium, do you think really something's going to be a big change, like in Indonesia, in terms of more political risk premium, meaning something extraordinary is going to happen near elections? No, it's a diagrammatically opposite case in Indonesia versus Malaysia, where you got plenty of political issues. You got basically limited structural reforms, whereas in Indonesia, the structural reform program very solid, and it's likely to be so from a balance of risk perspective in the election. So bottom line is, from a balance of risk perspective, it will probably pay off basically to be overweight equities, market rate fixed income, underweight cash in Indonesia. The positioning isn't as such, light position so far in equities. So if you wanted to partake in that trade from a balance of risk perspective, according to the RHB view, now would be the time to essentially do it. Now, our good friends in Thailand, they're like, okay, how come nothing on Thailand? As I already told you, there's going to be something for everybody today. All right. So we're long IDR Thai baht. Okay, if you notice, right? We've had this positioning on since like first week of May, and that is purely to do the idea that IDR against Thai baht is positive carry. In plain English, it's positive interest rate return right there. When you think about the trajectory of basically political risk premium versus in Thailand versus in Indonesia, we just have to be very focused and objective, right? I don't see anything on the horizon in the near term that would mean that the political risk premium in Indonesia goes up and the political risk premium being built into market psychology in Thailand dissipates quickly. You have a change in the administration, nothing wrong with that, but it takes some time for the new administration to come to the table with all the good stuff, whether it's policy reforms, whether it's social reforms, you name it. It'll take some time. It's a new administration. So there's nothing fundamentally wrong with Thailand from our perspective, but basically from a currency perspective, in terms of our key competitors in the region, basically we are at, IDR Thai baht, kind of esoteric currency, I must admit, but basically we're long IDR Thai baht on dips with a near-term target of 2.33 times 1,000. So I'm going to basically stop in about 2 minutes, but let me wrap up here in terms of our view on the Fed, the fundamental view, why we have increased the Fed funds rate forecast to 5.5 to 5.75%, from 5.25 to 5.5%, with the balance of risk that we may actually print 5.75 to 6%. Okay, so first of all, the Fed, from our perspective, our reading of the situation is hawkish. Okay, many people, basically the way that the bond market is reacting, at least in terms of US 10-year bond market, it's a little bit too complacent. We're hanging around here, 370, 380. We're just hanging around here as if the Fed is done. So that's what I'm saying. Expect basically yields to go up. Because the peak Fed funds rate forecast revised to 5.6 from 5.1%. As I mentioned earlier, incoming official data on growth, core inflation, labor market looking very resilient. Our proprietary satellite images of the U.S. economy as of June 6th, showing no signs of imminent recession. Things are good in America. We don't see any signs of credit crunch impacting broad economic activity. And as I mentioned, commodity prices are going to recover in the second half of the year. So in the interest of time, we got to keep it to 2 p.m. As the deadline. If we can now have questions, I'd be happy to answer them.
Okay, thank you, Doctor, for that insight. Okay, to our participants, you can key in your questions into the Q&A box below, or you can put it in the comments section in Facebook. Okay, while we are waiting, we can start off with this question, Doctor. So some of these US analysts have been conservative on the forecast for the US company's earnings. But it seems like the share prices continue to moving upwards on some of these risks on sentiment. What's doctor's view on earnings recovery this year for US company?
So from a balance of risk perspective, given that our GDP growth forecast is 2%, and the market basically, well, the Bloomberg consensus estimate is at 1.2%, as indicated in this third bullet point, second to the last bullet point. And the US economy, the US stock markets are essentially a good representation of US economy. It's not like places like Thailand and Malaysia with GDP, stock market, not as clear a relationship. So what we will see is that the earnings, from a balance of risk perspective in the second half of the year, that the earnings are going to remain fairly resilient. And the more likely scenario from a balance of risk perspective is surprise on the upside. That will mean that the market will continue to go up, particularly we think our favorite, as I mentioned earlier, if you want to partake in the US equity market, we like the S&P 500 financials index, we like the S&P 500 index. So for example, you want to keep it simple, you don't want to be involved in the US banking sector, that's fine, because our end year target for the S&P 500 is 4,800, which is a good 7% upside from current level.
Okay, thank you, Doctor. All right, moving on to the next question, touching a bit on China. So any sign of China's commodity market demand coming back soon?
Answer is no. So again, we have basically proprietary indicators for China, satellite images transformed by machine learning to data. And what we're seeing that the activity in sectors like steel, like in copper, like in coal is well below trend. Okay, so the Chinese industrial sector is continuing to languish, and that's not going to be the driver for us for a rise in commodity prices, broadly speaking, in the second half of the year. The main driver at the margin are essentially places like the US, India, emerging markets, and not China anymore. And there's a profound relationship between essentially global growth and things like oil prices. Remember that from a commodities perspective, they move together. So let me show you our chart, if I can find it. Where is this thing? Yeah, give me a second. Yeah, so if you look at figure 43, page 12, you will see that all commodity prices move together. And generally speaking, if you have a positive view on oil like we do, we think Brent oil price average this year is $80 to $90 per barrel. You should see things like food prices, metals prices go up as well on back of our summer recovery view in terms of US and global economic activity.
Okay. So still on China, Malaysia as one of the main trading partners with China. So how would you see this slowdown of trades, export trades in China affect Malaysian as an economy?
So as from an economic perspective, this has been kind of very a popular question. It doesn't mean that China exports won't recover, right? As global growth recovers, they will recover. They will also show recovery, but the pace of recovery is going to lag that of Asian economies. Okay, and that's primarily due to a lot of sanctions from the West hitting China's industrial sector and thus exports. The number one driver of Malaysia's export in terms of ultimate destination, not basically going through the further supply chain in China, going to other emerging market, into that those products then being funneled to developed markets as the US, Europe, but the direct ultimate destination of Malaysia exports is pretty much the US. So as long as you have a positive view on US demand for goods exports from Asia, Malaysia will basically benefit from that. And so our view all along this year, a view that is embraced by the government, I would say, is that we're at 5% GDP growth this year. Okay, the market is at Bloomberg consensus around 4.2%. The government and Bank Negara is 4 to 5%. Outgoing governor, as you know, about 2 weeks ago, mentioned that she sees the domestic economy remaining very, very robust. Inflation elevated, labor market looking pretty good, right? So in a nutshell, we're not that worried about the China effect on Malaysia macro. What we are worried about is this chart where it shows you MSCI Malaysia from a stock market perspective hasn't done well, right? 11.5% negative returns this year. And that's the reason why I think about 2 weeks ago, we went essentially overweight bonds, or overweight fixed income, market rate cash, underweight equities from our previous asset allocation specifically for Malaysia, of being overweight fixed income, market rate equities, underweight cash, which is semi-wrong, okay? So there are a variety of factors why the Malaysian stock market is not an accurate representation of the economy. So we're at 5% GDP growth, but we're basically, let's just put it this way, asset allocation for Malaysia, specifically underweight equities.
Okay, thank you, Doctor. Maybe now I pass to Indonesia. Berlian, you got any questions for Doctor?
Yeah, thank you, Alan. Thank you, Doctor. Dr. Sailesh, in the past, in the year of 2022, we see that the coming back from the technical side, for the technology sector is the hype of metaverse. Right now, the hype is already fed off, but how do you foresee about the AI? Is it going to be game changer for the next future? Thank you, Doctor.
Yeah, and as you know, Berlian, right? Basically, the AI has been one of the principal catalysts behind the Nasdaq, right? 31% return, right? So the market is already telling you, I think, that not just for this year, for the long run, medium to long term, that is definitely a theme, right? Because AI in itself doesn't need all that heavy stuff like like the chips, right? The chips technology is like prone to sanctions, from the West on China or hit Taiwan and all that. So the cleanest way to play from a balance of risk perspective, the tech sector, is through AI. That's the reason, right? Some of the, as you know, the companies which are more like traditional chips oriented, depending on the company, haven't fared well. Some have others, more mixed performance. But the AI is what's been driving the market up in Nasdaq, because that's a medium to long-term thing, that a trend from a balance of risk perspective, which isn't prone completely to geopolitical risk and sanctions. That's how I think, that's what the market's telling you. And I agree with the market.
Yeah, since you already mentioned also about the geopolitical risk, Doctor, we also see from the article, some article, that Warren Buffett already sold most of his stock in Taiwan semiconductor stocks. It's most likely because of the geopolitical situation as well. How do you advise for us to position our investment during this kind of condition right now? Because the tension is getting harder from this time being.
Yeah, and so what has happened is that I would suggest the idea that things related to China, right? Let's say in space, like the tech space, as one example of many, right, is an area in countries, markets related to that sector are places where you'll have continued problems. How do you play or work around that? How you work around that, the major beneficiary of this stress between, let's say, China and, let's say, Taiwan, right, is essentially that you're playing it through Korea, right? So you look at Korea, we're at 20% returns in terms of the MSCI China index. So the market is telling you, from a balance of risk perspective, that you would be safer playing Korea relative to Taiwan and China. Specifically China, let me reiterate, we are down in terms of MSCI China. We're not down now. As of 16th, at around 1%, we were down as much as 8%. So market is already suggesting to you the trade is in Korea and the US if you want to basically play tech.
Yeah, thank you, Doctor. So far at the moment, that's the question from Indonesia.
Okay.
I'm passing to Tanapat.
Okay, a couple of questions from here. So the questions, the first question related to the asset allocation for the people that who has like global fixed income and global equity. How would you like recommend to switch that? Like how you do the allocation for the fixed income and the equity fund?
So for how I would do it, right, is essentially in the equity side is cleaner. So I would say that, for let's say retail investors, from a balance of risk perspective, you're essentially playing a very boring instrument, which is buying an S&P 500 ETF or an S&P 500 mutual fund. The cleanest way to play the U.S. equity story. And when you think about essentially, the asset allocation of between between equities, fixed income, the typical portfolio is starting to work now, right? If you want to be really risk averse, it's 60-40. That's starting to work again. 60% equities, 40% fixed income. That's how I would think about it. It's hard to say specifically in terms of instrument, but I can share with you the big picture in terms of instruments that you would like to play when you look at, let's say you look at your credit fund, right? So you go 60-40, let's just say, all right, for your particular portfolio from a balance of risk perspective. And then in the fixed income portfolio, you are essentially switching from long duration bonds, which have already government bonds, which is done relatively well, and it's specific and more towards corporate bonds in terms of, we call credit, because the juice there is still far to go, simply because there's no recession in the world, no U.S. recession, no recession in this part of the world coming. So credit tends to outperform if you have a positive view on domestic and global macro.
Thank you, Doctor. The next question is about the currency. Why do you expect the USD strength in the near term? If Thai not like currency, political risk, what would you recommend to long the USD against the Thai baht?
I don't think that's where the juice is, right? I think the juice really, because the dollar is like not moving much, right? It may be a bit mispriced for my liking, right? The trade, that's why we have the intra-regional trade, right? Because the dollar is moving due to a variety of reasons each quarter. The safest trade, that's what I mentioned earlier. In foreign exchange, one of our top ideas is to long IDR against Thai baht, right? That's where basically you have the nice interest rate differential, and basically you are not prone to essentially the political risk premium that is still intact, and maybe the near term it remains intact in Thailand, because look at what's happened to the MSCI Thailand, right? We're down by 6%, right? Some of it, I wouldn't say you guys are the experts on that on the ground. Some of it is due to political risk premium. So as long as the stock market remains fairly weak, we're seeing the flows in Thailand. So let me walk you through what's going on in the flows front in terms of the Thailand equity and bond market, because that will affect your currency, right? Flows do impact the currency. So give me a second. There's like 100 plus charts now in this presentation. Yeah, so here's Thailand. Quite weak flows to the equities, and similarly in bonds, right? So the net capital flows picture for Thailand remains still very soft, right? It's a current account surplus country, I get that. But when you compare to, let's say, to Indonesia, you're getting essentially in the bond market nice inflows, right? Flat in terms of equity. So net, you're getting net positive capital inflows into IDR. So the flows picture for IDR relative to Thai baht is stronger. The interest rate differential is positive for IDR against Thai baht, and the political risk premium is basically lower in Indonesia relative to Thai baht. So hence our recommendation, if you want to sell Thai baht, what do you sell it against and what do you buy, is we would prefer buying essentially Indonesian rupiah with a near-term target of 2.33 times 1,000. That's been our view for some time.
Thank you, Doctor. No more question from Thailand.
Okay, thank you, Thanapat. Let's pick up the next question. So with the recent Blinken meeting with Chinese officials, what's your view, Doctor, on this initiative? Is it going to do well for the overall global, economies and between the countries?
I don't think so. It's just more of the same. As I say, as the Americans say, it's not my saying, but I believe in it completely. Also, talk is cheap. The geopolitical risk as far as continued China bashing by the West is going to continue. This is a long-term issue, which is unlikely to be resolved due to three main things. The song remains the same for me. One is the West is worried of a geopolitical and economic expansion of China. That's point number one. Point number two, they can't really compete, which feeds into point number one. And point number three is essentially they are worried also from a security perspective, defense perspective, what's going on in the Straits of Taiwan. So things are not going to change for a very, very long time.
Okay, thank you. Okay, next question is that what's the reason Japan market has been outperforming their peers this year? Seems like their currency also depreciating, but the share market is moving up. What's your view, Doctor?
Yeah, that's been one of the trades we've missed. So we had it on since last week. We entered the Japanese market, right? In terms of, I believe, the Nikkei 225. But I can share with you MSCI Japan, which has performed less than the Nikkei 225 at around 14% returns. So the way it works is that, from a balance of risk perspective, in my experience, if the US market has run, the European market has run, and you like developed markets, the next step is to invest in Japan from a purely asset allocation perspective, because the US market has given you strong returns, right? S&P 500 around 14%, NASDAQ 31%, the DAX has given you 20%. So then, as we entered like the second quarter, we saw the Japanese market exploded, right? Simply because the allocation towards Europe and US from a balance of risk perspective have probably been fulfilled. We reached kind of the limit in terms of the benchmark, right? So basically, what else do you put in DM? If you're long DM, short DM, you essentially put Japan in. So that's purely asset allocation, right? Rebalance it, if you want to call it that. The second aspect is that, generally speaking, if you foresee a weak yen in the short to medium term, you're long the Japanese market, equity market. The reason is because a lot of the index constituents are export oriented. So the fundamental belief in history has been, from a balance of risk perspective, weak yen, buy Nikkei, right? That's two. The third aspect is that in terms of looking from a fundamentals perspective, growth looks okay, inflation is fairly tame, so there's no macro headwinds, or fourth, any sort of political headwinds that is hitting the Japanese economy. And it always helps for a big investor like Warren Buffett going out there and saying he is investing in the Japanese equity market. So that the fourth aspect is incentive. That's why the market is running. So we are long, essentially, Japanese equity market currently since about a week ago. We missed that trade, but nevertheless, we're in it now.
Okay, thank you, Doctor. Okay, this is coming back to Malaysia ringgit. There's two parts to the question. I'm sure this is one of the questions that all Malaysians want to know. So, what's the main reason that the ringgit is so weak? And if the ringgit were to hit 470 and above, how does it impact the inflation and overall the economy in Malaysia?
So someone maybe read my report in the newspaper or something. 470, huh? So let me walk you through the chart. So I have, like I said, something for everybody.
Which chart is that? Which chart is that? Maybe Eric can share the chart.
It's okay. Can you see my presentation? I already went offline.
This chart, no. You currently can't see your chart.
No, I know. But you still see my presentation, right?
Now no more.
Yeah, I don't know why. Basically, let me share. Sorry. I have to share. Sorry. This is important.
Okay.
Yeah, sorry. Okay. Is it better?
Yeah.
You can see now, right?
Yep.
All right. So let me walk you through the charts for dollar ringgit, right? So one is basically purely from sentiment, right? If you look at figure 56, right, you'll see that the market, the green line, any number above zero, is that the market is long dollars versus the respective currency pair. In this case, ringgit, right? People very negative against ringgit versus the dollar. And the main reason why you have this positioning is essentially due to, let me see if I've got that chart. I don't think I have that chart here. Yeah. Anyway, the main reasoning you are seeing this dynamic figure 56 is that the interest rate differential is negative, right? Of holding ringgit versus dollar. So let me illustrate by example. It's really easy. So you go to your friendly sales guy at RHB Retail Brokerage and say, hey, I want to put money in a 3-month to 12-month deposit in ringgit. Okay, how much do I get? I get 3%, right? Then you say, okay, I want to put some in US dollar. How much am I going to get for that same 3-month to 12-month deposit in a multi-currency account at RHB Bank, right? 5%. So automatically, it's a no-brainer, right? I get 5% versus 3%. That's point number one. So what we call the negative interest rate differential. It's not the case always in life, in markets, that you have negative interest rate differential, the currency will depreciate. If you believe that the capital gain on the currency, meaning the currency will appreciate against the dollar by more than 2%, because the government is coming to the table in terms of future interest rate hikes, such that the carry dissipates. Government is coming to the table with fiscal reforms, such that the medium to long-term outlook for growth. This is a highly indebted economy where the debt to GDP ratio is going up. That will help future growth and productivity potentially. Then you could get 2% return at least. And so I don't need to be essentially selling ringgit against the dollar, none of which is happening. First, negative carry, meaning negative interest rate differential. Is the Bank Negara going to 3.75% in terms of OPR rate? Probably not. Our view is that the peak is around 3.25%. So not much is going to help you in terms of interest rate differential. The second, the debt to GDP ratio is going up. So the currency, as it relates to or correlates with subsidies as a percentage of GDP, the dollar ringgit, as it correlates with the fiscal deficit as percent of GDP, is tight. So you tell me a story. Alan tells me a story, the subsidies are gone, the fiscal deficit coming down, I'm buying ringgit against dollar. But that's not what the government has come to the table with. We're getting nothing like that. And so it doesn't give you a picture in terms of improvements in the debt dynamics of the country, leading to future improvements in growth and productivity. And then the last aspect is, many people have been essentially suggesting in the consensus trade has been, the dollar is strengthening. So ringgit basically is moving with the dollar. Completely wrong. So figure 55, you look at this momentum of dollar ringgit, and I'm sorry, I don't have that chart, but when you plot this against the DXY index, the dollar index is actually coming down, but the ringgit is going up. So the bottom line is, it's not a dollar story. It's essentially a domestic issues story. So for us, we're quite clear that essentially if these domestic issues, such as much higher OPR rates, significant fiscal reforms, domestic confidence in the currency are not forthcoming, and the reflection also of this domestic confidence is foreign currency deposits in Malaysia going up, stock market volume completely collapsed, and that's why you have essentially the Malaysian stock market, one index, you guys look at the Bursa, but I'm just like looking across the world, MSCI Malaysia, we're down 11%. The domestic confidence is super weak. So what that means is that the balance of risk, if this good stuff that I just talked about, domestic issues are not contended with soon, the balance of risk is we're going to retest essentially the highs in November around 470 and change. I think it was around 474 or so. And in the medium term, we can't rule out in the medium term, not immediately, we could essentially head to much higher level, right? So I would take these opportunities, any strength in dollar ringgit, to essentially switch out and buy. My favorite trade now is Singapore dollar, right? So forget the dollar, right? It's stable against the dollar right now, around 460, 461 and change. So for those of you, I don't know of many people who have a lot of dollar needs, but certainly I think most of us on this call, including Alan, has a mansion in Singapore, Nassim Road, needs Singapore dollar. Essentially, near term, we're looking at a target 345 to 50 and a level of 350 to 360 in terms of Singapore dollars. So you sell ringgit and buy Singapore dollars. That's how we think about it. Yeah, situation is not going to change very soon. Yeah.
Okay, so sounds like it's going to be quite tough for the Malaysian market. So with the upcoming, some of these state elections that's coming up. So there's one question that also asks, how would this impact, or is it going to improve anything of the outcome of the state elections?
So the currency issue, among with a whole host of issues from our side, led recently to change our long-standing asset allocation for Malaysia. Remember, the global asset allocation and the domestic can be different. Each country is different, obviously, right? So we changed our asset allocation for Malaysia specifically to overweight bonds, market weight cash, and underweight equities, because we think that the currency pressure will continue in terms of depreciation pressure. That's point number one. The second point is that the foreign interest in the domestic stock market is low. And the third, as you say, the political risk premium, domestic political risk premium, as we're heading into the state election, particularly in important constituencies such as Selangor, the balance of risk is basically, it's an open field. Anything can happen. So whether, at the margin, whether, the incumbent remains in power, let's say in important constituencies, Selangor, for us is basically somewhat irrelevant, because the trend is our friend, meaning from my team's perspective, to essentially think that the Malaysian stock market is going to continue to remain under pressure due to the fundamental factors that I had highlighted earlier. You have much better places to invest, so from a regional perspective, we like Indonesia, so call up your favorite sales guy, which is Berlian, and say, hey, how do I get exposure to Indonesian equity market? So JCI has done only 1%. Now is the time for you here in Malaysia, from a balance of risk perspective, that if that market is likely to run from an equity market perspective, maybe you start thinking about that and call up Berlian immediately and don't answer Alan's call. It mainly does Malaysia. Okay, that's a joke.
Okay, thanks, Doctor. Okay, the next question is that do you still maintain your view that the US 10-year yield will hit 4%? And what happens if it hits and what if it don't? Because this will widen the Malaysian-US rate differential and a weaker Malaysian ringgit perhaps?
Correct. So, someone has been reading my report. I'm happy that someone, at least one person, has been reading my report. But we have just revised up in terms of our view in fixed income, right? So in US 10-year bond yield forecast for second half, we're now at 3.7 to 4.2% average, okay? And we revised it up from 3 to 3.5%. And our client is right. You know, I have been indicating that we're going to around 4%. We had tracked higher to 3.8%. We're basically going to hit 4%, and the balance of risk is going to eclipse 4% in the near term. So what that means is eventually, right, life is not that straightforward that you get an immediate reaction in currency market. You're lucky, sometimes it's immediate, sometimes it takes some time, right? So what that means is that if we are, let's say, near term at 4% and balance of risk that we break through, more likely at 4.2, basically above 4%, yes, the pressure on ringgit to depreciate further against the dollar will increase. And our near-term target, I didn't talk about this in this report because I just had to go to the key points, is that our near-term target, dollar ringgit target of 4.70 remains intact, okay?
Okay, that doesn't sound too good.
Is what it is, as the Americans say, Alan.
Okay, let's move on to the next question. With the new governor, Bank Negara governor, is he a dove or is he a hawk?
So I'm sorry, I won't be able to answer that question right now. I have some personal views. We haven't published it. But all I can tell you is the nomination of the new governor, from our perspective, all I can say right now, it doesn't change our view on the currency. Okay?
Okay, fair enough. Okay, let's move on to the next question. What are the reasons Indonesia has been outperforming Malaysia in terms of FDI and also IPO this year? We are a bit jealous of Berlian, you know.
Yeah. Well, it's because of Berlian, right? We basically a good presentation and marketing skills for the Indonesia story, and so the Indonesia story continues. Okay, so what is the Indonesia story? Right? The Indonesia story has been, as Berlian, asking some questions related to tech, right? Basically, some of the problems we've seen out in China and Taiwan obviously have been a major beneficiary. Some, not all. Yeah, you know, they've gone into more of the high tech, like EV parts and components, high tech portion of tech, and that has been an attractor for FDI. Right? I think it's at early stages. That's the first point. Second, the Indonesia infrastructure story continues. Okay. You know, we see continued progress in project implementation, and that's good for long-term growth, right, and productivity. That's the second bullet point. The third bullet point is that, you know, the things that people like to invest in Indonesia, right, from a stock market perspective, what do they invest? They invest in consumer, they invest in banks, they invest in infrastructure, they invest in commodities. Okay, so if you look at consumer, looking good, right? Labor market conditions holding up really well. If Berlian wanted to, leave RHB, he's going to get at least 30% increment. I kid you not, right? Most people, you get it 30% easily. Okay, so labor market conditions strong consumer. Okay, infrastructure we already talked about. The banks solid, right? Basically, because you've had a very good, performance in terms of consumer. As well as infrastructure program being very strong, then obviously what does that mean for the banks? The loan growth profile remains very, very strong, right? And that's what has supported the bank. So the only genie in the box concern of both domestic and international investors has been commodity prices. Hey, if the commodity prices don't go up, then the Indonesia market cannot go above the 1% JCI, return to this year. However, if you believe that commodity prices will go up in the second half of the year based on our global macro view, it should mean, and currency going to 14,000 to 14,500, it should give you that tailwind from a balance of risk perspective to be overweight equities, market weight fixed income, and underweight cash in Indonesia. Now, at the other end of the spectrum, there are two sides of the spectrum. Indonesia is here, bullish. Malaysia, bearish. And the reason is that the structural reforms that were supposed to be implemented by this new administration haven't come. They're talking about reducing the subsidy, in reintroducing the GST, attracting FDI, right? And nothing like that has happened, right? And the currency has been under pressure to depreciate big. And the currency that you should look at is not dollar ringgit in itself, but Singapore dollar ringgit, multi-year high, right? And now, as you say, Alan, your good friends are now headed for election. So, you're required to vote, Alan. Yeah, you're Malaysian, so go and vote. I'm just kidding. But bottom line is, where's the juice? Where's the juice in the market in Malaysia? You got nothing. We've got very little things, catalysts, that are going to say to you, oh, wow, looking good, buy. We just don't have that here, right? So.
Okay. All right. Maybe we go one more round to the region. See if there are any more questions. Berlian, anything more from your side?
The additional two questions from Indonesia, it's about commodity, and Japan is already answered by Dr. Sailesh. So thank you. No further question from Indonesia. Alan.
Okay, thanks, Berlian. Tanapat, anything more from your side?
No more question from Thailand as well. Thank you.
Okay. So with that, I think that comes to the last question that we had just now. So before we end, I would like to thank Doctor for sharing your view and answering almost all the questions. And also a big thank you to all the participants from near and far. So please join us 8 a.m. together with RHB research team every morning live on RHB Morning Kappa at 8 Facebook group for up-to-date market and economic outlooks, latest company updates, and also exciting trading ideas. So till the next session, have a good week ahead and see you soon.
Thank you, everybody. Bye-bye.